With increased financial tightening and growth concerns as banks around the world attempt to rein in inflation, it wasn't an easy quarter for KiwiSavers. Morningstar Asia Pacific Director of Manager Research Tim Murphy joins me now to talk about his latest survey. Welcome, Tim. So it was another tough quarter for KiwiSavers. What sort of stood out to you the most?
Yeah, I think the thing that really stood out the most from a diversification perspective is just the role that currency can play in, protecting Kiwi investors in times, of risk off. So we saw, a sharp depreciation of the New Zealand dollar over the quarter, which really helped protect asset values across the board. So despite the negative headline news, despite negative numbers that you see printed in local markets overseas, when translated into New Zealand dollars, returns actually weren't that bad. So when we're talking about depending on your risk profile, of course, between conservative through to aggressive, minus 1.3 through to minus 1.8. Given the negative news in the world and what's gone on in markets, that hasn't actually been too bad an outcome. And we certainly had a lot of downside protection provided there. Particularly for those with more offshore exposure, which many of the larger KiwiSaver options have.
And sort of in the past, there's been the perception that sort of conservative funds never go down. What trends are you seeing in terms of inflows and outflows of people from those funds?
Look, we haven't seen massive, big picture headline changes in flow patterns to date. I mean, there's other than cash, there's no investment that you could say you can't and won't go down. And obviously, with the falls in bond markets that we've seen obviously sharper negative returns in conservative funds that many people may have been used to historically. So I think that's really brought to bear that there are risks in investing in bonds as well as investing in equities, and you certainly have seen a double whammy of that this year in terms of both going down. But when you think about investing through a cycle, and certainly when thinking about new money from here, obviously bond yields starting from now are as high as they've been for many, many years. And so from a forward-looking basis, when people are thinking about their investments in their KiwiSaver settings, it's certainly the return prospects for conservative funds are much better now than they have been for many years, given the starting level of yields.
And would you expect more fund movements at the moment, given the volatility?
We obviously hope not. I mean, KiwiSaver, we're constantly reminding people is a long-term investment, and so you should be making choosing an option that has that setting in mind. And so making changes to your KiwiSaver option based off 3 month or 1 year performance is it's a fool's errand, and it's a path to destroying capital. So by all means, everyone should be confident in checking and understanding which option that they're in, and making sure that's appropriate for their long-term goals and needs, for which KiwiSaver, for most people, is supposed to be the target objective. But reacting and changing that, or trying to go more conservative because equity markets are down, it's bound to destroy capital over time. And there's no shortage of studies that show switching to more conservative options after market gone down has inevitably led to poorer investor outcomes.
And there have been some big annual declines in aggressive funds as well. Have you noticed much change in terms of inflows and outflows there?
Not at a headline level at this point. So I think a lot of the drawdowns over the course of this year, as they've taken place over 2022, I think in some ways probably haven't been fully digested by investors. I think year end might be a good time where we may see more activity. Obviously, as I said, we would hope not to see that, because people who have chosen that option, markets go up, markets go down. So while aggressive options are down the most this year, they're up the most over 3, 5, and 10 years, and that is a more realistic time frame for the majority of people with a KiwiSaver account. And so short-term volatility is part and parcel investing in the markets, and if you're taking a long-term view and you've chosen a more growth or aggressive option for that reason, then the fact that that's suffered a drawdown this year is no reason to change that.
And changing tune a little bit, how are the sort of default KiwiSaver providers performing?
Yeah, it's a mixed bag. So obviously that was very topical at the end of last year. So we're approaching the 1 year anniversary of those changes happening. So certainly for the next round of this report, we will have a bit of a focus on how default options have gone in their first full year. So I can tell you year to date that of the 6 options, 3 have beaten the category average, 3 haven't. So It's kind of an average outcome, I guess you would say.
Hmm.
Some a couple doing well, a couple doing not so well. So you would, yeah, it's obviously less than a year is too short a time frame to be drawing too many meaningful conclusions. But it certainly hasn't been a standout. It hasn't been any standout achievements, from the on average, certainly from the new default providers in their first year.
And we've seen a bit of consolidation recently with Fisher acquiring Kiwi Wealth and sort of forming a pretty dominant top six. Should we expect to see more consolidation?
Look, potentially, obviously you see that in other retirement saving systems around the world. Obviously, KiwiSaver, despite being sort of circa 15 years in existence, is still relatively early in its journey compared to other systems. There's the potential for consolidation to build scale. There's certainly an ever increasing focus on fees, and one way to obviously be able to bring fees down and make them more competitive is to have more scale in your business. So that's certainly one way of doing that. Whether we see that flow through to members, in these schemes you just mentioned, we'll see. But certainly we expect that could happen over time. Also depends on the strategic interest of the major players, a la the banks and AMP, in terms of their future views on the importance of KiwiSaver to their business. But equally too, you're seeing newer players that are more nimble, maybe more focused in certain areas. You're having a go with their more niche offerings in KiwiSaver, and some of those are attracting interest. So I think you potentially could see some consolidation over time, but equally too, there's still newer entrants, I would say, having a crack trying to get their piece of the KiwiSaver pie.
And would that be good or bad for the market?
I think more competition is really a bad thing. So the more people can bring a competitive offering to market, then over time people resonate with that. That's not to say that every new offering will be good or worthwhile. Many or some of them, no doubt, won't be. And over time you'll find the market will speak for itself. But certainly more competition is really a bad thing.
And on sort of a similar note, recently we've seen a slowdown of new providers entering the market. So do you think we've reached a peak?
I won't say we've necessarily reached a peak. Certainly, I mean, obviously the pullback in markets tends to put a slowdown on product provider activity, whether that's new products, whether that's marketing existing products. So you're seeing that across the board, not only within KiwiSaver, but right across the investment spectrum and the managed funds universe. So that's not unusual given where we're at in the market cycle. But over time, as I said, it wouldn't surprise us to see other newer entrants have a crack and try and bring in a new idea or new niche to the market.
And is the New Zealand market already saturated?
I mean, there's no shortage of options, but like I said, it's still early days in the overall growth of the scheme. So while there's no shortage of options, that's not to say that isn't potential for newer providers, if they can carve out a niche, to try and bring some more innovation to the KiwiSaver market.
And recently there's been some talk about sort of changing KiwiSaver legislation to make dual contributions with their partners. Do you have a view on that?
Look, I think as long as a KiwiSaver vehicle is used appropriately, which in most cases is for longer term retirement savings, obviously it can be used for in shorter term withdrawals for housing purchases, but if it is focused on that longer term retirement savings outcome, then the more you're able to save to do that, whether that's through dual contributions or any other mechanism, again, is not a bad thing. So it's a system that is being well designed. It's not perfect by any stretch of the imagination, but certainly incentives are in place. Certainly appropriate for encouraging long-term retirement savings mindset, and anything that encourages greater usage of that is not a bad thing in terms of helping the long-term retirement outcomes of New Zealanders.
And are there any sort of potential impacts of something like that coming into play?
Yeah, I mean, I think in terms of the market, the amount of money you're talking about isn't big enough to push the market around. While the New Zealand stock market, isn't that large on the global scale, it's also not that large a part of most KiwiSaver portfolios, right? Like global equities tends to be a much larger portion or allocation in the majority of KiwiSaver options. And so, I don't see it having a big effect on a market level. I mean, at an individual level, like I said, hopefully that should encourage greater savings and greater or therefore better outcomes, in the long term for retirement. So that's really a bad thing.